in China, and good evening to those listening in North America. I'm Dune, your moderator for today's program, China Tech M&A Market Spotlight. This is brought to you by the World Financial Symposium, an international organization dedicated to educating technology leaders. The WF flagship conference is Growth and Exit Strategies for Software Entrepreneurs, held in technology capitals around the world. Next one is in Silicon Valley on November 7th. Quorum is to be the platinum sponsor of today's WFS webcast. The Quorum Group is a global leader in tech M&A with offices around the world. We've privately held software and related tech companies in anyone in history. Cultural interest in China and the broad Asia-Pac region due to strong growth and a maturing technology culture. For several months, Quorum representatives have been on the ground in Beijing, Shanghai, Hong Kong, and Shenzhen, negotiating on behalf of our clients and building deep connections with the region's investment, financial, and technology hubs. We've also recently hosted some of China's leading investor groups here in the U.S. Today, we'll first hear a report on key trends and drivers on tech M&A in China by Sean Liu. Following his presentation, we will cover the 8 steps on how to sell your company for an optimal outcome, presented by Quorum CEO Bruce Milne. In the webinar, our panelists will speak in English with slides in Mandarin. If you have questions in either language, please use the comments box on the right of your screen. We'll start Q&A session. And now let's turn to Sean Liu with Riverside Capital Advisors in Shanghai and his update on key trends and drivers in China's tech M&A. Thanks for joining us today, Sean.
Thank you for having me. Jiahao. China's importance to the technology market is widely understood these days. We saw Apple set the stage for a major push into the country with its newest iPhone as just one example. But even with its billion consumers and rapidly growing technology industry, China has not been involved with much tech M&A. But that is to change. Historically, IPOs have been the dominant exit strategy in China, where a market for new issues enable funds in some cases to gain more than 30 times the amount invested. IPOs peaked in 2010, but stock performances and some accounting fraud have damaged investor confidence. There is only one IPO so far this year, and that IPO by e-commerce firm Light in the Box can't be building any confidence, as shares down over 7% from the open. The firm has been hit with a class action lawsuit by U.S. investors accusing the company of artificially inflating their opening price. Into this wild growth, the government implemented a freeze on IPOs on Chinese exchanges. Starting October 2012 and still ongoing in order to implement new IPO rules. Rules only recently proposed are designed to combat corruption and to shift China to a more managed growth model. This is to drive increased M&A. Private equity firms in particular are encouraging M&A activity to replace the missed IPO activity of the past. Equity partners, Bain Capital, Bain Private Equity, and Unitas Capital have all taken M&A exits on deals. A key driver for companies to strike deals is the need to consolidate China's fragmented industries, where top players often take less than 5 to 10% market share. And in the case globally, the largest tech firms have immense amounts of cash that will need to be spent. Companies like Baidu, Alibaba, and Tencent face pressure from shareholders to spend cash. China is primed for a flurry of deal activity. The challenge for China now is to look beyond its own borders. 3 core tech M&A and the buy and sell side is currently internal. Most of the buyers of Chinese companies are from the West. Other Asian countries combine for just 11% of transactions. We see a pattern even more pronounced for Chinese buyers. 3/4 of the deals internal, followed distinctly by North America, are then by the rest of the world. This state of affairs will not last. Though there are challenges to Chinese firms engaging in cross-border M&A as the market continues to mature, companies will align and make ways to make it happen in order to take advantage of the unique opportunities such deals provide. With China, Beijing dominates the M&A scene, following Hong Kong and Shanghai. Shenzhen and the rest of the Guangdong province north of Hong Kong also contributes significantly to the deal flow. This is of particular note in regards to cross-border M&A because Guangdong is notably underrepresented. Other locations across China are in similar situation, though with lower volume overall. Buyers follow a similar pattern, though Shanghai in particular has significantly less activity on the buy side than sell side. Also, there is more diversity of Chinese buyers than sellers in general, as some tech firms from across the country pick up technology assets to diversify their products, services, and portfolios. Much of Chinese technology deals in recent years have centered around either online video or IT services. With services, there have been a number of acquisitions by private equity-led consortiums in 2013. The largest of these was the $890 million acquisition of telecommunication services firm Info by CITIC Capital and Temasek Holding. Just later, Pactera was taken private by the Blackstone Group for $660 million. The services firm had just been created a few months before via M&A, when Huawei and Advanced Info merged in November. On the video side, giants Baidu and Youku have done the heavy hitting. In March 2012, Youku swallowed competitor Tudou in a $1.1 billion acquisition, a multiple of over 13 times Tudou's revenues, with the company controlling 1/3 of China's online video market. Baidu, China's largest search engine, has not sat idle. In May of 2013, acquired PPS TV for $370 million, combined with its previous video assets to create a platform that can compete with Youku. Now it's Alibaba's turn, and the giant is on the hunt for online video itself. After taking a swing at PPTV, is now in talks to acquire a video platform from Sina, China's answer to Twitter. Looking at a broader set of deals, broken down by sector, provides further insight. One thing to note immediately is that while IT services predictably has seen the most deal flow, all sectors are well represented, a good indication of the maturity and breadth of China's technology market. With services, as mentioned, the major theme has been acquisitions by private equity firms. Even to Pactera and Asian Info, iSoft Stone was acquired by China AMC. With the amount of cash still in private equity hands globally, Asian IT has been a logical place to put it. Comparing the cross-border acquisitions of those within China, we can see that IT services is overrepresented in international deals. As with technology firms in other sectors increases, the other sectors catch up via both private equity and strategic buyers. One sector will be consumer applications, including video games and digital media, where the prospect of 1 billion customers will certainly prove tempting. However, at the moment, the biggest mover and shaker in this sector is on the buy side, with doing a number of significant minority deals globally in the gaming sector. Recently, they were part of a consortium that picked up Vivendi's 25% stake in Activision Blizzard, but also made sizable investments in Epic Games and Riot Games. Vertical applications tackling specific markets such as energy, transportation, and government are the reverse of IT services. In that, significantly underrepresented in cross-border deals. Noting is that vertical companies are being acquired roughly evenly across China, a sector where Beijing does not dominate. One more vertical deal was SAIF Partners taking private transportation solutions company China Trans Info in 2013 for $190 million. The sector has seen significant deal values, as mentioned before, and Baidu in particular has been active. Just a month, they did their largest deal ever, a $1.9 billion acquisition of 91 Wireless, an app store, calling it an important entry point into the mobile internet. In addition, Baidu's major deal in recent years was its $106 million majority investment in travel website Qunar at a valuation of $408 million. The early signs of significant consolidation in the internet travel space that is still continuing, and the indication of the consumer clout of China's growing middle class. Sector in a cross-border internet deal of note as well. Walmart's majority investment in rapidly growing online grocery giant Yihaodian in 2012. The company was founded in 2008 and surpassed $1 billion in revenues in 2013. Governmental intervention disrupted the deal somewhat, adding restrictions to the ways the firms could cooperate. But ultimately, the deal got done because it was in the interest of all the parties concerned, a common theme even in small deals that hit such snags. In these major internet deals, the horizontal sector, enterprise application used across sectors such as CM, ERP, and business intelligence tend to be smaller. One example is Ztelic, a social media business intelligence startup acquired Yahoo as part of its global shopping spree. The deal Yahoo's first in China since it took a stake in Alibaba in 2005. This Yahoo to begin to build its talent in the country, and Ztelic founder Hao Zhen, a former Yahoo employee, will play a significant role in the leadership of their Beijing Global R&D Center. He could end up being a key player if China makes a larger acquisition the next year. The interest sector, including storage, security, system management, and related software, is notable because volume is small, the international interest is high. There have been nearly as many deals crossing borders as internal. The only sector where the numbers are comparable. One indicative border acquisition was Equinix, the California-based co-location and data center services firm. A Chinese data center operator, AsiaHome, last July for $230 million. This acquisition was a classic market expansion move, adding 8 customers in China, Hong Kong, and Singapore. Clearly, there are significant opportunities for Chinese buyers and sellers in looking abroad. For buyers, Western technology companies can provide valuable connections, linguistic assets, access to U.S. and European markets, and for the U.S. in particular, the opportunity to make acquisitions while U.S. companies are cheap.
Sean, thank you for that report. And there's some fascinating activity coming out of China right now. As I listen to your deal count, I'm reminded how important China and Asia-Pac are to companies like Yahoo, which you just mentioned. We recently did a breakdown of Yahoo's M&A frenzy led by Marissa Mayer. But lest we forget, Yahoo's Q2 earnings were comprised over 60% by Alibaba and Yahoo Japan Holdings. Certainly not something to shrug at, and it's great to see that they're continuing to reinvest and focus on the region. So thanks again, Sean. And with that, let's turn to Bruce for the 8 steps in creating an optimal outcome for your company.
Sean, Yahoo is already at 20 acquisitions, and they're setting the tone in Asia. Before I into optimal outcome in the 8 steps, let me briefly talk about some China software IT M&A growth issues. Sean just mentioned one of them, and that's the issue of leverage. But before that, one is language. There clearly is a language barrier. It's important that we try to bridge that. We are increasingly involved in China. Both sides we're finding trips are delayed because of visas, and we're hoping that smooths out. The insularity, oftentimes the Chinese will sell to Chinese buyers. We've seen this in other markets. France, for example, for years, they'd always sell to French buyers. Then they realized that, frankly, most cases, 85% of the cases, are going to get a better value outside of France. Experience just takes experience to do these deals. They aren't doing that many deals, and once they start getting experience doing cross-border deals, transactions with the West, they'll get more and more comfortable. Sean, you spoke of as leverage is that a Western firm gets access to the Chinese market, vice versa, the Chinese firm gets access to Western markets, Western technology, distribution, feet in the street. It's daunting for some expanding into the West to not have a partner. It's daunting for somebody expanding into China not to have a partner. So there's some real leverage in doing transactions internationally. Communication related to this, and connections, knowing the right people, and getting over issues of trust. As M&A today, the inherent problems for a seller are that you are diametrically opposed on the issues of price, structure, liabilities, taxes, and non-competes. You're butting your heads on those issues. Further, the M&A process is tougher today. It takes time in the regulatory environment. It's more tasks than people realize to get through due diligence. The buyers are busy. They're looking at hundreds of opportunities. Tougher side professionals, more complex due diligence required, and deal fatigue because of all this. So certainly you have a process that works, a process we call optimal outcome. What is optimal outcome? Well, simple goals. One is value maximization. Two is creating the best structure. Three, you minimize personal liability and risk. Four, reducing taxes. You don't be paying more taxes than you have to. How do you structure deals that are optimal in terms of employment and non-compete agreements as you go forward? How do you provide for proper integration so that yours is one of those transactions everyone can look back on and say it worked for both sides? This is based upon 8 stages. 8 stages what we call for optimal outcome. Base stages, let me briefly go through them. Stage 1 is preparation. It's critical that you do good preparation for good results. Set some timelines, allocate your staff resources, conduct due diligence as if you're going to be buying your company yourself. You're the buyer. Imagine what are the things that they're going to be looking at. What are the questions they're going to be asking? Business and marketing plans. They'll ask you for those, both present and future. Differentials and projections ready. You'll need 3 years of projections. Have presentation materials ready, both for that quick presentation as well as a more detailed presentation on the technology. And be collecting due diligence materials you know they're going to be asking for: contracts, agreements, patents, copyrights, that sort of thing. The next stage is research. What's going to be? And buyers on both what we call the A and the B list. The logical A list, the B list, there's a lot of firms out there you don't know about that may be interested in you. Perform strategic analysis on each buyer. What would they want to buy you? You need to understand that. Preliminary evaluation. They're going to ask you this: how much do you want? You need to think about that and get some consensus among the partners and investors. Determine per contact. Who do you contact at these firms? You have to be very careful. If you have the wrong contact at the wrong level, you won't get the responses you want. They won't take you seriously. Outside advisors and board influencers in the buying side that you need to know about. There's a lot of people on the other side that will be involved in the transaction. Who are they? How can they affect you? Remember, they can kill the deal. And you prepare a position statement for the buyer. Why want to buy you? What is the overall plan here? C is contact. Introductory correspondence. In most cases, this is actually written correspondence. Many firms have electronic submissions. Draft customized executive summaries. The reason I say customized is that each of the participants, each of the potential buyers, may have a different message. Enter NDAs and non-solicitation agreements. Know in advance what you're going to want. Interest, valuation expectations. Establish a log on all the communications. You need to keep track of this because you'll lose track of what you said to each party. And reposition your process based upon feedback. They'll tell you why they like you. Then stage 4, discovery. This is something we've drawn from our friends in the legal community. Coordinate conference calls, site visits, and meetings. Establish technology and review processes. Prepare a full evaluation report. You're going to have that. Develop GA contribution analysis. Why won't you? CAs with customers and contractors. And finish due diligence on the buyer. Are they capable of buying you? Negotiation. And what you want from both sides. Right, structure and valuation guidance. Create an environment. You have to bring each party along in some cases separately. For example, those parties that know you the best may be the last parties you contact, because everyone at the same position in the process at the same time in order to get competing bids. The top bidders, who are they? Sign a letter of intent, all right? And inform the other bidders of a no-shop. So when you go into a letter of intent, you have to inform the other bidders that you're working with one party exclusively, and you'll get back to them if that doesn't work out. Finally, 6, we get into due diligence. At the same time, we're doing contracts. You have to provide financial statements, projections, determine if outside advisors or opinions are needed, establish a confidential data room where all the information goes and can be accessed by all parties. You need to go technical, legal, and ownership due diligence. Do you have proper ownership? Have you gone through all your contracts proper? And the ownership of the technology, very, very important. Written explanation of the business model and the methodologies. To put this down someplace. And you need to complete the definitive due diligence agreements and have all the attachments done. Now we close, stage 7. Warranties, the trust grows holdbacks, any opinions are needed by outside counsel, contracts, arrange payment and distribution, regulatory filings, do disclosure schedules, and of course, celebration. It's interesting, a lot of times these processes are sort of anticlimactic with the final filings. And stage 8, which we include, is integration. Think what it will be like post-merger. This requires some planning in advance. Think through what you want during negotiation post-merger. The synergies, best practice analysis, the interim transition team to make this work so people don't leave. Keep those people longer term. You set up a monitoring reporting. Follow the traction to make sure it's working. This process, if done right, will yield optimal results, but it takes a while. A global search takes about 9 to 12 months. You can know fairly quickly who's going to buy you, but frankly, even in letter of intent, agree that you're going to be selling for a certain amount. But it will still take months to close the transaction. Overall, both in-house and professional services on both sides is about 3 to 5 man-years of work. But it works. This process works. In a global search, what percentage of the time will other buyers be willing to pay more than the first party that approached you? I say the first party because many times you'll be approached because somebody wants to buy you. They want to buy you because they want to get you inexpensively. There's almost someone else out there willing to pay. In fact, the statistics show us over 27 years of doing this, 75% of the time, there's somebody out there willing to pay more and willing to pay on average 48% more. The process is unique in a sense that it allows unique access and entry to top executives. When you go to a transaction that's just a reseller license, you deal at the division level. Joint venture alliances, you might be dealing with finance or marketing and manufacturing. When you say the magic words, do you want to buy my company? You're right to go to the tops of these firms because these CEOs are essentially builders. If we look at these companies, and it's true in China too, these larger firms are really a collection of acquisitions. They have to look at and buy these smaller companies because that's where the new technology is coming from. There are 5 major benefits to this process that every firm gains. Again, is experience over decades of doing is selling more companies than anyone in history. First, what we've found is if you go through the process properly, you do proper presentation, preparation, you develop a much better model. You're looking at your company in an objective, dispassionate way. And you'll find that you look at it and you learn from the process, the feedback, you get a better model. Secondly, research about your competition and buyers helps you refine your strategy, your position in the marketplace. Third, and this was an interesting one we found in the process, you get extraordinary feedback. When people see your story and they listen to you, they give you feedback because in many cases they have a lot more invested in this marketplace than you do. They have users, distribution, feet on the street you don't have, and a long history. And their feedback is completely invaluable actually. Relationships. When you go to the world with your message, you open doors. You go on DA with a number of firms, on average about 12 to 15 firms. And look, nobody's a buyer. About 70% of them aren't buyers. They can't buy you. But those doors are open for relationships that may be valuable down the road. The 5th benefit of the process, you're looking for an exit. You're looking for that partner. So let's just get the 5 benefits here. these benefits can justify the time and expense of a global search for a partner. Let me give you a case study, an example that could happen anywhere in the world. This one happened to be a small U.S. company. They're a firm about $3 million in revenue. They want to offer about $5 million. We got 2 offers for them of between $5 to $8 million. And there were different kinds of offers. In one case, it was stock. In the other case, it was some cash and earn-out. Those 2 offers fell apart. One of the companies, their stock went down. They couldn't buy. The other one, Champion, the party on this side who was we were dealing with, left the firm. We had to start over. We took the company off the market into a process called hiatus. They learned a lot from the process. They developed a better market. Their research refined their position. But great market feedback. But they opened a lot of doors. And during the hiatus period, they did about 4 or 5 joint ventures with those firms that weren't buyers. We took back out 18 months later, and guess what happened? 100% recapitalization at a $3 million value. We sold them to a private equity firm. That private equity, they still kept 10%. Within 2 years, they sold again for $100 million. So they started out with valuation expectations around $5 million. They end up getting around $40 million total. That happens if you do it right and use the optimal outcome process.
Thank you for your presentation. Thank you for your presentation. And with that, I do see that we're coming up against our allotted time for today. There were a number of questions that came in through our private comments channel. We'll be sure to answer those one by one. For the moment, we've just got time for one question. I'm going to go ahead and throw that to Quorum HQ. Bruce, do you want to take that question?
Well, that question around growth, we talked about the past and some of the markets, and we talked a little bit about the process, and there was a question about the growth. What's it look like going forward for Chinese firms? We think there's going to be a lot of activity for a number of reasons. On my side, you saw from Sean's presentation that a lot of our private equity firms, they have over $1 trillion, and they are looking internationally for investments. And so that's some of the largest deals have been by private equity firms. The strategic buyers have over $400 billion now, and here's what's most important. 7% of the funds of the major firms like the Googles and the Apples and the Microsofts and Cisco, 70% of those funds of the $400 billion are offshore. They're outside the United States and cannot be repatriated to the U.S. They have to be used right now for acquisitions. So they're going to be on the hunt for good acquisitions internationally. Target 1, we think China's going to be right at the top of the list. On the side, on the supply side, Sean only 1 IPO, and been hundreds of investments in technology companies by venture capital firms and private equity firms in China. They're sitting on scores of companies that have not been able to go public, and they have to sell. So on the buy side, we have record cash and demand, a growing global economy, and on the sell side, we have companies who want to sell and need to sell. Right there at the 30-minute mark. So we'll thank all of you for coming. Other questions we had, we'll be getting back to you privately. Thank you very much for joining us at the World Financial Symposium Technology Conference on China and M&A. This is our conference. Thank you for attending.